When S&P came out with their rating last year for strategy, they stated that they gave zero credit for the Bitcoin. And so I know some of the people on your show have talked about why strategy has a junk rating from S&P, but when you actually read the methodology and they say they did not give literally a single penny of credit for the Bitcoin, strategy has over 800,000 Bitcoin. Like when I talk to actual institutional buyers, trillion-dollar asset managers that have positions in strategy and Strive, they think that that's a joke. They actually just completely write off S&P's rating methodology because they don't give credit to the Bitcoin. Now, to S&P's credit, when you look at Basel frameworks and the financial kind of, whatever you would call it, regulatory bodies, it makes sense to me why S&P today might say we give zero credit to the Bitcoin. But when you put it in the perspective of an asset manager that's actually tasked with underwriting the credit risks of these agencies, like I can literally go on a call with a trillion-dollar asset manager, say S&P gave strategy a B- rating. Look at it, they gave zero credit to the Bitcoin. Do you agree with me that there should be some credit to the Bitcoin? Every single person says absolutely, the rating is too low. And our view on digital credit actually is that it solves one of the biggest problems in at least America, probably the world right now, which is the retirement crisis. And so my background, I came from a pension. I've been all in on helping solve the retirement crisis for everyday Americans. And what we see is that there is an income problem. And we've seen this for years. The 60-40 portfolio being dead. My view is that 40% of portfolios of most people, the income portfolios, there's just not a lot of attractive options.
The number one question to understand the direction of markets is this: is the data center cancellation rate going to increase or not? That's it. That's the whole question. The demand for chips, the demand for infrastructure, the demand for energy is there. The hyperscalers are trying to hand the money out the door to Micron and NVIDIA and TSM and Broadcom. But you are seeing higher cancellation rates and increasing public backlash, including from politicians. And by my count, I believe all the presidential contenders in the midterms, which will come into focus on the other side of the bicentennial, are voicing some concerns around this. The other constraint is at the energy layer. We saw this deal that was announced today in the Wall Street Journal. Chevron's providing a 2+ gigawatt data center for OpenAI, which is tremendous, right? There's no data center that consumes that much energy on the planet today, to put that in perspective.
My other piece of advice to the CME would be you should be real careful what you wish for on this one. Because as somebody also familiar with the guts of Dodd-Frank, one, everybody remember the distinction between a future and a swap is at the discretion of the CFTC based on certain factors, which are not the payoff profile or strictly having an expiration date. If you really poke the bear, they have a huge amount of discretion looking at these things. They could easily say rolling a futures position is actually a swap because now you have eliminated the expiration date and it needs to trade like a swap, right? And you're not going to like how that works compared to futures treatment. They can also go the other way and say, as long as you construct your swap as a rolling sequence of indefinite futures, this is a futures contract.
If you hold crypto on your phone, your biggest vulnerability isn't your wallet, it's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again, and SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2 middle-to-end encrypted secondary numbers for banking and signups, so you stop handing your real number to every app that asks. Go to cape.co/unchained and use code UNCHAINED for 33% off your first 6 months. Fidelity has been researching and investing in blockchain since 2014, long before it was a headline, and they're hiring crypto and DeFi professionals to join their team and discover what's next in finance. Fidelity is looking for people with fresh perspectives from different backgrounds, whether it's tech, UX, or product design, whether you're crypto savvy or crypto curious, as long as you have the passion to make a real impact at a company striving to make finance accessible to all. Explore crypto careers at Fidelity today and make the decision that could change your future for the better. Visit crypto.fidelitycareers.com to learn more. That's crypto.fidelitycareers.com. Fidelity is an equal opportunity employer. Before we dive back in, a quick word about something we make ourselves. If you like the way we cover crypto on this show, clear-eyed, no shilling, just what actually matters, you'll like the Unchained Daily. It's our free newsletter that lands in your inbox every weekday, with the most important stories in crypto written by journalists, not marketers. No jargon, no hype, no number go up cheerleading. Just the news you need to stay ahead in the time it takes to drink your coffee. Subscribe for free at unchainedcrypto.com/newsletters. Heads up everyone, we've now fully transitioned Bits and Bips to its new dedicated channels. So if you're not yet subscribed to the new Bits and Bips channels on X, YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts, go there and subscribe now. For the next few weeks, we'll play segments of the full interviews on Unchained as a reminder, but for now, you'll only hear those short segments of Bits and Bips on Unchained, no more full episodes. You can get links to all of the dedicated channels with the full episodes at unchainedcrypto.com/bits and bips, spelled BIPS. Thanks again.
When S&P came out with their rating last year for strategy, they stated that they gave zero credit for the Bitcoin. And so I know some of the people on your show have talked about why strategy has a junk rating from S&P, but when you actually read the methodology and they say they did not give literally a single penny of credit for the Bitcoin, strategy has over 800,000 Bitcoin. Like when I talk to actual institutional buyers, trillion-dollar asset managers that have positions in strategy and Strive, they think that that's a joke. They actually just completely write off S&P's rating methodology because they don't give credit to the Bitcoin. Now, to S&P's credit, when you look at Basel frameworks and you know the financial kind of whatever you would call it, regulatory bodies, it makes sense to me why S&P today might say we give zero credit to the Bitcoin. But when you put it in the perspective of an asset manager that's actually tasked with underwriting the credit risks of these agencies, like I can literally go on a call with a trillion-dollar asset manager, say S&P gave strategy a B- rating. Look at it, they gave zero credit to the Bitcoin. Do you agree with me that there should be some credit to the Bitcoin? Every single person says absolutely, the rating is too low. And our view on digital credit actually is that it solves one of the biggest problems in at least America, probably the world right now, which is the retirement crisis. And so my background, I came from a pension. I've been all in on helping solve the retirement crisis for everyday Americans. And what we see is that there is an income problem. And we've seen this for years, the 60-40 portfolio being dead. My view is that 40% of portfolios of most people, the income portfolios, there's just not a lot of attractive options.
The number one question to understand the direction of markets is this: is the data center cancellation rate going to increase or not? That's it. That's the whole question. The demand for chips, the demand for infrastructure, the demand for energy is there. The hyperscalers are trying to hand the money out the door to Micron and NVIDIA and TSM and Broadcom. But you are seeing higher cancellation rates and increasing public backlash, including from politicians. And by my count, I believe all the presidential contenders in the midterms, which will come into focus on the other side of the bicentennial, are voicing some concerns around this. The other constraint is at the energy layer. We saw this deal that was announced today in the Wall Street Journal. Chevron's providing a 2+ gigawatt data center for OpenAI, which is tremendous, right? There's no data center that consumes that much energy on the planet today, to put that in perspective.
My other piece of advice to the CME would be you should be real careful what you wish for on this one. Because as somebody also familiar with the guts of Dodd-Frank, one, everybody remember the distinction between a future and a swap is at the discretion of the CFTC based on certain factors, which are not the payoff profile or strictly having an expiration date. If you really poke the bear, they have a huge amount of discretion looking at these things. They could easily say rolling a futures position is actually a swap because now you have eliminated the expiration date and it needs to trade like a swap, right? And you're not going to like how that works compared to futures treatment. They can also go the other way and say, as long as you construct your swap as a rolling sequence of indefinite futures, this is a futures contract.
If you hold crypto on your phone, your biggest vulnerability isn't your wallet. It's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again. And SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2...
Hi, everyone. Welcome to another episode of Bits and Bips, the interview. My name is Steve Ehrlich. I am the head of research at SharpLink and also your host. We've got a really exciting show today, but as always, before we begin, nothing that you hear or see on the show should be considered financial or investment advice. For full disclosures, please see unchainedcrypto.com/bits and bips. And let's take a brief pause to hear from one of our sponsors who make the show possible.
This episode is brought to you by Cape, America's privacy-first mobile carrier. Same premium service you'd expect from any other carrier, but designed so your number, your location, and your data actually stay yours. Get 33% off 6 months at cape.co/unchained. Fidelity has been investing in blockchain since 2014. They're not wondering if digital assets will shape the future. They're hiring the talent to help ensure they do. Explore opportunities today at crypto.fidelitycareers.com. Fidelity is an equal opportunity employer.
All right, welcome back. So really exciting guest today. I have Carmen Li. She is the CEO of two different companies, Silicon Data and Compute Exchange. And she's basically created an entire industry focused on tracking the price of GPUs during this just exponential increase in demand. So welcome, Carmen.
Thank you. Glad to be here.
Really excited to have Carmen, you as a guest, and we've been friends for a long time, ever since our days at Citi. Really impressed with everything that you've been doing since you left Citi. I guess since we both left, I became a journalist, and now I'm at SharpLink. You went to Bloomberg, and I think led like all enterprise data partnerships at Bloomberg, which anyone who ever has a Bloomberg terminal knows is a pretty big job. And then you got involved in sort of building an index tracking GPUs for the first time. Excellent foresight given where everything has gone, and you're building out your entire, enterprise to not just track the prices, but also build the financial plumbing, the infrastructure that will underpin all of it. So really excited to have you on today.
Thank you. It's always nice to speak to a friend.
Yeah. So, I mean, look, we're going to talk a lot about potential areas of overlap, similarities and differences between what you're doing and areas of commonality with crypto. But just to make sure everyone understands what you do, what your two different companies offer, can you please just give me the 2-minute elevator pitch on Silicon Data and Compute Exchange?
Yeah, of course. So Silicon Data is the Bloomberg market intelligence layer of compute. So think about us as the Bloomberg S&P for compute, meaning we have indices, we're alternative data, we're benchmarking, we have everything around intelligence layer, right? So for example, our GPU indices, token indices, things can actually very soon can be tradable at different exchanges, right? So you need data, need information, need financial products, that's Silicon Data. Compute Exchange, the other side, is the marketplace for compute resources procurement. You could actually get compute resources through forward contracts, reserve contracts, refurbished GPU. You actually can get servers from us, and token packages, which we'll be announcing very soon. So you can get actual physically delivered compute resources at Compute Exchange.
Great, and I mean, your progress has really been tremendous. I mean, maybe talk a little bit about that, and in particular, anyone that has been kind of watching your progress. I mean, you've been on CNBC and Bloomberg. You were just on Odd Lots. I mean, you're launching futures contracts that are going to be traded on CME. I believe they're cash settled at some point in the second half of this year. Would love to hear more about that. And then just in particular, in a world where there's so much demand for GPU resources, how do you build an index that tracks it? I'm not a tech person by any stretch of the imagination, but I know enough to know that there's all different types of setups. Like, this is not a homogeneous commodity as much as GPUs perhaps are becoming commoditized. So how do you integrate that into an index that can just track the price so people can hedge exposure or speculate?
Yeah, so give you a little history, right? So you mentioned a little bit as my Citibank experience. Before that, I was at the DRW doing option market making for different commodity products and also different index products. So purely from a market participant point of view, as a trader point of view, I really want a market that's liquid, trustworthy, and have excellent price discovery mechanisms, right? I moved to Bloomberg, obviously, get a tons of exposure from the data business itself, including indices. The way I look at compute in 2024, right, when the whole post-ChatGPT, when I saw even 2024, I saw tons of AI software companies starting already, right? They're leveraging GPUs back then, leveraging potentially other large language models. They're creating services and products for hedge funds, right? So what was interesting back then is they have great business traction, which was good for them. At the same time, they were complaining to me about their margins. So translate to they, even though their top line was fantastic, they could not control their cost component, which translates to their margin was all over the place. They could be negative. They have no control over that. It's almost like, it's in my mind, it's like, yeah, of course, like American airline cannot hedge your oil prices or any airline, right? It's a big problem for them to manage your operations, right? For any businesses have a huge exposure to any source of natural resources, right? Or resources in general, it would be nice for them to hedge, either from revenue point of view or from cost point of view. So in my mind, compute will be the largest human resource very soon. If that's the case, we need benchmarked price discovery for this particular asset class. And to your point, no commodity is the same, right? Even oil, the different grades of oil, you can't really shifting oil from one place to different refineries, right? There's a lot of nuance to that. Similar to GPUs. That's the reason why we start indices saying that, hey, let's separate out A100 from H100 from B200. They actually have very different architecture behind that. Even within the H100 family, for example, there's 20, 30, 40 configurations. Translate to they have different CPU, different RAM, different interconnect, different geolocation, for example, right? We have to normalize it even within the subclass before you can start doing calculation, or you're just comparing apple to oranges, right? That's very important process to normalize to a base case, and then you do settlement process on top of that.
And talk to me just a little bit about the volumes that you're seeing. In particular, I know that you're seeing some significant growth on compute exchange. And I believe it focuses more on GPU rental, so it's not the same thing as people buying directly from NVIDIA or any of the other fabs, but just contextualize that a little bit.
Yeah, there's a few layers to this, right? When NVIDIA with their partner Dell, Supermicro of the world, when they sell servers, right? So that's people, hyperscalers, new cloud, they consume servers from those OEMs, and then they start rental process, right? They rent it out to people like enterprises. So once the server is out of Dell and the other OEMs, the rental prices are complete at supply demand curves. They don't control the rental prices. It's purely demand supply driven, right? So that's a very interesting factor. That's what we're really looking at. It's the on demand compute per GPU per hour rate. So there's a lot of numbers being thrown out how big the AI infrastructure market is. Some numbers have been around for a long time. Talk about $600 billion expenditure for the server buildouts. Obviously, NVIDIA recently mentioned in the future they're looking at $3 trillion. Derivatives market usually 10 to 15x the spot market transaction. So you're looking at a range of 6 trillion to 30 trillion derivatives market easily. Right, so that's that particular market alone. For compute exchange wise, right? Obviously, we don't target every single thing out there as an exchange. We're targeting people coming RFQ, different number of nodes, doing auctions, and then to your point, we don't do on demand at this point. We do reserve, longer term contracts, and token. We definitely see hyperbolic growth at compute exchange. We see clients from traditional AI startups to enterprises to inferencing platform, even to cloud provider themselves. Some of the months I look at the growth is like 1,000% month over month. I was like, this is crazy, right? The market as a whole, the notional traded, I'm getting used to numbers, right? Like billions is just the way the market is. Everything is 100 million to billion. It's the size of market. That translates to why the index and derivatives layer is so critical. All the notional traded is so huge. You have to have a really good very understood basis trading going out, right? For you to hedge accurately, because again, the size is just really dwarf other asset class.
Yeah, and I want to. That's pretty fascinating, and I know in crypto a lot of times we're talking about like different asset classes. People have been trying to do the AI trade. People have, in all sorts of ways, trying to kind of appropriate onto what they're doing. But your product, I mean, what you're building, you're seeing real volumes, and it's really satisfying a true need, which I think is something, that product market fit that we're always searching for. I want to get a lot more into it, but I think a nice place of convergence is just to talk a little bit more about your experience dealing with the CFTC. You're partnering with the CME in terms of launching those cash settled futures contracts, which will happen at some point in the year. My audience in particular is very familiar with the CFTC because people in crypto, they strongly believe, rightfully so, that most digital assets are commodities. They're not securities, and therefore they fall under the CFTC's purview, not the SEC. And especially when it comes to launching different types of futures contracts on regulated futures on CME, I mean, some of those, it's a different type of environment where, unlike the SEC, where you need kind of formal approval to do everything before launching an ETF, the CME kind of provides some additional deference to issuers and lets them innovate a little bit more with the ability to sort of step in if deemed necessary to protect market integrity, et cetera. So I'd love to just hear a little bit about your experience dealing with the CFTC, especially if you can at all under the new chairman, Mike Selig, and sort of what it's going to take or what are the steps necessary to get these new futures contracts to begin trading.
So personally, I haven't met Mike yet. What we have done in the past 2 years, right? We started in 2024. We've been very transparent to all market participants. Hey, this is what we're looking to do. This is the indices we think going to tremendously help with price discovery, for hedging, for risk management, for the whole entire ecosystem. It's going to be critical. We've been very transparent every step along the way. Obviously, my stakeholders, some of them have been communicated to CFTC and other regulators. The good thing about our relationship with CME as well as the future products, it is very traditional, for better or worse, right? It's not extremely different, right? If you think about another futures launch, it's on the line as a class, cash settled, or full exactly same CME process. So if a future account with CME today, you don't have to do anything different, right? Your bank, for anyone, FCMs of the world, for you, it's just adding another contract versus doing anything different. So that's a good thing. Obviously, we will be beginning up meetings and reviews with CFTC very soon, which I'm really excited about. CME has been tremendously helpful throughout the process.
All right. So what really got me excited about bringing you on is talking about the areas of overlap and convergence with crypto, because there's just so much demand to get involved in the AI trade. I mean, there's even actually, I think it's on Objective, there's one DEX already that has some degree of perp futures related to GPUs that I don't think is doing a ton of volume. It's on Helix, but I mean, there's so many different protocols and projects that are offering like tokenized compute resources, tokenized agents. There was so much excitement surrounding the SpaceX IPO, ways to like perp futures, looking at like to trade it before it even actually IPO'd. There are, I guess, like synthetic opportunities to get tokenized access to like the likes of Anthropic and OpenAI, and it actually became a whole other issue that kind of blew up. But when we were talking, I mean, you've sort of mentioned how you've been inundated with requests from some of these platforms to perhaps bring your product, your index in particular, on chain. And it's really interesting too, because I know Hyperliquid in particular, they licensed the S&P 500 for one particular perps market that they have now. So I'd really love for you to just kind of share some of those stories, share some of the what those experiences were like for my audience.
Yeah, so I'm very new to the perpetuity markets and anything. It's pretty much traditional capital markets focused. So my experience is actually twofold. It's pretty interesting. One is on computing side. we have a lot of providers. They were traditionally the mining facilities, right? Data centers. They are converting to AI data centers. So we've been working with them, right, helping them think through, hey, how do you think about migrating to different servers? And some servers you're not doing dynamic air cooling. Translate to you can't support some of the servers, or you don't forget about liquid cooling, right? So we're doing a lot of infrastructure transformation with.
I'm sorry.
Go ahead.
I'm sorry. Your audio cut out a little bit in the very beginning of that answer. Did you say that you've been working with some of the Bitcoin miners that have been looking to transition from Bitcoin mining into just like long-term HPC computing contracts?
That's right, AI-centered compute. So facility-wise, people are some of them at least choose to pivot, I guess, to more AI-centric compute providers.
At this point, I think it's pretty much all of them. I actually did a show on this, I think a few months ago, and I mean, virtually they're all pivoting because the mining economics it's so adversarial. And HPC, you can sign like a 10-year contract with Google or some other hyperscaler, and you're just set because there's no way to replicate all of the power generation and the infrastructure. You can't just recreate it like that. So that makes a lot of sense.
It sounds very different. I was caution them, you might not be, your facility itself might not be set up to serve the Vera Rubins because of, coolings and your whole infrastructure. You can at least the floor support the new server weights, right? For example, that's a simple physics for math. And then the flip side is financial innovation with Silicon Data, right? So I'm always pro financial innovation. To me, is what is the core purposes of that, right? Take any products, my limited understanding of perps, right? The additional value you can bring is really the 24/7 angle, the weekend trading, right? And then some other the nature of design perpetuity futures versus the term structure, right? The rolling and everything else. So there's a different value proposition for perps. But same time, to me, is always to S&P, for example. S&P is a very liquid product in traditional finance, right? And then we know the product itself is very solid and provide a very true economic value to the general public. So the underlying core S&P is a solid product. And then in the same time, I think for any purpose to make sense, purpose to wrapper, right? What's the product itself? Can this product, the indices itself, this product itself can it actually do the price discovery, the hedging needs in the real world? Right? If your product is something that's manipulatable by others, right, or doesn't have much, really trading attractions, then whatever wrapper you put on is just not going to be helpful.
Yeah, I'm curious. I want to double click on that a little bit because it cuts to, and we were talking about this a little bit yesterday. It cuts to like the core value proposition of perps and derivatives in general, and it's sort of, in my mind, a little bit of a cousin to the idea of having cash settled futures, because what's the utility of that as a hedging tool to someone just that's not intimately involved in those industries? If I'm an orange farmer and I want to do like physically settled futures, I understand the value of that and protecting sort of my revenue, et cetera. But I mean, just like traditional markets, derivatives are so much bigger than spot. GPUs right now, it's the inverse. I think we're going to get there, and I am curious your thoughts on how like the products you're going to be launching with CME, and I think ICE is actually launching a competitor too, because there's so much demand for this. But what you're launching with CME and how that might smooth out price discovery, how that might just be beneficial in order to kind of help companies involved in this industry hedge and. To the extent you think perps can be useful. I'm very much on record, even going back to my time as a journalist, at saying that like, at some point, I think sometimes derivatives can just be detached from reality. I mean, I interviewed Sam Bankman-Fried a million times, but one of the first conversations I ever had with him long before like FTX blew up and all of that, I asked him why he was offering 100x margin on derivatives at FTX. Like what is the actual utility of that? And it created such volatile swings that, I mean, people couldn't put on very big positions because just like a very minimal swing would just liquidate. And he said, well, people wanted it. And so I'm curious, like how you reconcile all of that? Because having a liquid derivatives market can certainly smooth over a lot of the nuance that you laid out earlier in your answer. But at the same time, we want to make sure that it's not just only speculation for speculation's sake.
100%. So the way we design contract, we have our natural hedge in mind, right? If you're building a data center, there's a number of hours you're looking to rent it out. You have your spot exposure. For example, most of the time you're doing 1 year, 2 year, 3 year long contracts, right? Your financing can be 5 years versus your customer contract can be 2 to 3 years. What's going to happen in the next 3, 4, 5 years, right? What kind of volatility? You need the money to pay down your loan, and your revenue is uncertain. Can you hedge that for that particular duration? That's interesting about GPU. It does have a term structure, right? Versus, let's say, other things. You need to hedge your term structure efficiently. You need a data future products. That's why I think GPU by itself naturally landed to data future as a better fit product. However, large language model token, for example, we have for better or worse, now very famous large language model token indices. It is continuous. People use that on the weekends. Maybe it's a better Perp product, but I don't know, right? So I think it depends on underlying assets. The better product can be different, right? So that's one thing. The second thing is about liquidity. The way I think about liquidity, obviously, to your point, it's, leverage is one thing. The way I think about it is bid-ask spread, right? If a product has a really wide bid-ask, it's not very efficient for you. It's expensive to hedge, right? That translates to. I like, selfishly, a very narrow bid-ask spread for my products. That translates to liquidity, translates to cheaper to hedge for every market participants, right? So that's what I'm looking for. The efficiency of the product really drive up the liquidity and the market participants, and the who are natural hedge are going to come to you. The only reason they want to come to you is you can actually help them to hedge. And then to a point about competitors, the way I think about this, I actually believe in capital market efficiency. I believe people will gravitate towards the best product for their needs. Your product design is not relevant, is easily manipulated by others. The basis trading is all over the place, then maybe less people want to participate because of the flaw of your indices versus others, right? Once the trust has to be built, right? The financial institutions have to trust your indices to put trillions dollar swaps on your indices, right? How do we get that, right? So that's going to be a gradual process. At the same time, it takes a lot of rigorousness in methodology, data breadth, depths, right? All those things come into play.
All right, well, we're going to get a lot more into that. But before we do, we have to take one more break so we can hear from one of our sponsors.
If you hold crypto on your phone, your biggest vulnerability isn't your wallet, it's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again, and SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2 middle-to-end encrypted secondary numbers for banking and signups, so you stop handing your real number to every app that asks. Go to cape.co/unchained and use code UNCHAINED for 33% off your first 6 months. Fidelity has been researching and investing in blockchain since 2014, long before it was a headline, and they're hiring crypto and DeFi professionals to join their team and discover what's next in finance. Fidelity is looking for people with fresh perspectives from different backgrounds, whether it's tech, UX, or product design, whether you're crypto savvy or crypto curious, as long as you have the passion to make a real impact at a company striving to make finance accessible to all. Explore crypto careers at Fidelity today and make the decision that could change your future for the better. Visit crypto.fidelitycareers.com to learn more. That's crypto.fidelitycareers.com. Fidelity is an equal opportunity employer. Before we dive back in, a quick word about something we make ourselves. If you like the way we cover crypto on this show, clear-eyed, no shilling, just what actually matters, you'll like the Unchained Daily. It's our free newsletter that lands in your inbox every weekday, with the most important stories in crypto written by journalists, not marketers. No jargon, no hype, no number go up cheerleading. Just the news you need to stay ahead in the time it takes to drink your coffee. Subscribe for free at unchainedcrypto.com/newsletters.
All right, welcome back. So we were talking about sort of the applicability of Carmen's businesses to crypto, some of the nuances and challenges associated with bringing her products and her index on chain. And I want to go a little bit deeper because I know, and you've talked about how you've been courted by many of the without naming names, many of the major like DEXs and Perp issuers or Perp marketplaces to sort of license your index to them, similar to what the S&P 500 did, et cetera. And I'm sure that it's interesting, potentially appealing to you. But you did mention how you were also asked they made a few requests of you that you found very unusual and, dare I say, concerning. So I'd love for you to just kind of walk us through a couple of those experiences.
Yes. So again, I'm extremely new to the perps market. So it was great to receive that kind of enthusiasm from perpetuity marketplaces. So almost everybody, right, reached out, have conversations. So my question to them is always, hey, love to explore. Tell me, what should I do? What kind of product that will be interesting enough for your audiences, right? What kind of a relationship you're looking for? A few things at least odd to me from traditional, again, market participant point of view from capital markets is one of the things is so bizarre is they ask me, hey, Carmen, aside from licensing indices, will you consider become market maker of your own indices? And I thought they were joking, right? Because clearly there's a huge conflict of interest by me trading my own indices that completely erode the neutrality from an index provider point of view, right? By them asking, I thought they were completely joking, and I realized they were not joking. And then I was like, you do realize a big conflict of interest. Are you doing that with any other indices? They were like, yeah, we do that with other indices, asked them as well. And I said, did anyone said no? Because it's by design, it's not supposed to do so, right? So it's fascinating to me that was even a discussion to begin with, right? That is not something I will feel comfortable as a trader, right? To trade a product, I know the index provider also can trade their own products. That's number one.
Yeah, and maybe just to explain a little bit more, again, we have a sophisticated audience here, and they're quote unquote like bilingual in terms of crypto and TradFi, but maybe just give like one or two examples for people who perhaps may not understand the significance of you market making on your own index. What are the risks?
How do I explain this? It's almost when I tell my daughter, hey, you can go play if I decided that my work can be done by 4 p.m., right? And then I'm the only person who decided if I can work by 4 p.m. or 5 p.m., then her ability to play or not completely rely on my preferences, right? So for example, if I have a open interest of a position on my own indices that's long, right? It'd be really hard. It's the natural incentive for me to set up my indices at a higher price, right? Because I will benefit from this particular position versus others, right? Such a huge conflict of interest. And everybody can say, hey, the trading side is different than my index settlement and price side, but it doesn't matter. Your incentive as a company to maximize P&L, there's a huge conflict of interest. You can't give the power of deciding settlement prices to the provider while you're trading at the same time.
Yeah, I appreciate that, and it
wasn't even a question, right?
It really is. Clearly, it's in your interest for your index to keep going up and up and up, and as you're looking to I mean, potentially licensed to some of these perp offerings, and many of which, I think the vast majority of which are quote unquote like unregulated and probably geofenced around offering or servicing U.S. clients. At the same point, I know that there's, I think there's some ETF issuers that are potentially looking to launch products based on your futures contracts at CME. And I could only imagine the SEC and CFTC having some real big questions about the fairness of those products if, like, theoretically you have the ability to manipulate the price of your index that everything is based off of.
So that's incredibly important for us to make sure that our neutrality stands, right? That's why we're going through external audit on Silicon data through ISO compliance, third-party lens, right? We have very strict internal trading policies, right? Not only you cannot trade my indices, obviously, but you have to disclose your other positions, right? For example, you long NVIDIA, right? That can be a potential conflict of interest. Everything taken extremely seriously as Silicon data, as an index provider. As we said, everything in our world, the skill is just unparalleled compared to other product, other asset class. So that's number one. Number two is, I think it's interesting when I talk to the perpetuity market issuers and market participants. Another things I was bringing up is, how do you make sure the index, obviously they have their choices, right? How do you make sure it's not be manipulated? It's very important, right? When you pick partners, and how do you make sure the trader can actually make sense? Some of them suggest that, hey, by the way, we're gonna pipe your indices and mix with other indices. And to me, it's all right. So when you're gonna move from one indices to the other, they have different methodologies, and they're actually essentially different products. Right? How can anyone trade if you just anytime can switch from one to the other? How are you going to keep your position open and closed? Just sounds like, again, another box of worms just came up, right? I think the lack of understanding of the GPO markets, the index per itself is a big problem for me to pick the right partners. Essentially, when my product become tradable at CME, we have a suite of institutional players. They can't wait to use our indices to hedging. We talk about all the banks, hyperscalers, neoclouds, big AI companies. We're talking about billions of dollars traded at traditional indices, traditional fusion options products, right? The energy traders and all the basis trading going to be happening. And then if they're gonna, I'm sure some of them want to have a purpose venue, right? I don't blame them for that. How can we make sure they're trading in the purpose markets on my indices and also in a regulated, in a very similar rigorousness as traditional markets? That's something I'm looking for, right? I can't just publish my indices and let people trade without being able to sort of guardrail that particular venue.
Yeah, it's really interesting the point you mentioned about like how you can't just swap indices. I don't have a ton of experience with this, but one of my prior roles in crypto was at Kraken, and if you don't know who they are, Carmen, I mean they're one of the larger. Oh, okay, you do know who they are, and they have a dedicated index business called CF Benchmarks, and I used to work with their team to understand, and they're actually a partner with CMA, and to work with their team to understand like how they build these indexes, the types of like redundancies and resiliencies built in, like which trading platforms are allowed to feed in, which one, like what's the criteria for inclusion, or then perhaps being like excluded or relegated. And I mean, just looking at, I'm blanking on the name of your one other competitor with the New York Stock Exchange, their index, I think, is based on a slightly different methodology than yours. It's more based on like just like the actual transactions. And I'm not necessarily saying one is better than the other. I'm sure you think yours is better, but I'm also guessing that you probably say that theirs is not wrong. It's just different. But it means you can't just swap them out because like they're not, they might be cousins, but they're not identical twins. And like that's a nuance that professional money managers will understand. Retail traders may not.
So one of the things I do want to that's correct, but then it's some people's marketing and PR just went all over the place. I want to correct that. We are building on transaction prices plus other observable prices. We have 200 data provider information, and then we are the most well-covered indices, which translate to with the least easily manipulatable, meaning you have to manipulate 200 data sources of ours, which is It's very, very hard to do versus you have 2-3 data sources. Just because your transactional price doesn't mean it's not manipulatable, right? If you know there's 2 data sources and you do one trade can change your prices, you can do so.
And so we're very familiar with the term of wash trading and like uneconomic trading, which can certainly be used to push up a price of something. So we got
your transaction price doesn't translate to you cannot be manipulated, right? The best way to hedge that, right, risk is having a variety of data sources. And again, there's a huge pipeline rigorousness. You have to throw what to include, what not to include is over standard deviation. It's a real trade, but hey, the price is 2 standard deviation against your prices, right? You probably have to throw that out, right? How rigorous is the data pipeline? So all those into it's very, very rigorous, a very complicated process to create indices that's tradable. And to your point, I think the capital markets will vote by trading volumes, right? Which one they think will most helpful for their hedging needs, speculation needs.
What do you think of the CFTC, like quote unquote, approving U.S. regulated perps? I know that there's some litigation ongoing. I think the CME is taking exception to it, but I mean, you're launching cash settled futures. Have you paid attention to this at all?
So obviously, from a market observer point of view, I've been following the news. From my point of view, I think there's a time place for everything. For GPU futures right now, I think data futures is best use cases for hedging term structure risk for GPUs. So I do believe that's the best venue to start and let the natural hedger come and actually hedge the exposures with the other counterparties, right? And then going forward, obviously, we're totally open to do different things as the liquidity starts building up.
Okay. I mean, one other aspect of crypto I wanted to touch on before we kind of wrap up by taking a broader picture of everything is that you also told me that you're very open to accepting stablecoins as payments and had conversations with one major industry player, if you feel comfortable talking about. And it really would just come down to, I think you said customer demand, but could you just sort of walk us through your thought process there?
Yep. So for compute change, we had discussed, should we take stablecoin or any currencies, right? Obviously, we open whatever facilitate as an exchange, right? We have to facilitate any transaction that both party in the market demands. So we're completely open to do so. We had, to your point, we had discussion last year talking about wallet integrations and both ends. Obviously, as a marketplace, you have providers and sellers and buyers, right? So they have to want it on both sides. Where we don't really push either way, right? So if they both want that, we have to support whatever form they want to do. The nuances is, again, we're talking about huge dollar amount for almost all transactions, right? And sometimes it triggers different form of payment and deposit and monthly recurrings and things. The billing process can get complicated, and we do clear trades. Sometimes we are an intermediate, taking payment from one and transferring to the other. So there's a complication involved with that. But yeah, as a company, from compute change point of view, we have to take any form of payments as both party depends.
Yeah, I could just imagine. I mean, maybe just to level set in real numbers, like what is a typical size of a transaction? I mean, this stablecoin market cap right now is about $300 billion. It fluctuates. U.S. Treasury Secretary Scott Bessent has suggested it could get to $3 or $4 trillion by the end of the decade. I mean, at that point, who knows? What are the dollar transactions that you're seeing? I mean, people are familiar with the headline numbers of hundreds of billions of dollars, even trillions of dollars of investment, but those are like the big guys. Like, what are you saying?
So we see, which is the beauty of exchange, right? We don't only cater to the large player, which we do. If you think about per GPU power, as it seems, say $5 per GPU power, every node has 8, right? And then every hour of day, right? Once you enter a contract, you're paying every single hour, right? So if you need 2,000 nodes, right? And you times 8 times $5, and then times 24 hours times the duration, quickly becomes billions of dollars, right? It's very, the math just adds up. So as exchange, we do provide liquidity to people who want 1 node, or 2 nodes, right? For a year, all the way to people needs thousands, 20, 30, 40, 60,000 nodes easily. So we have a big wide range in terms of contracts. So in terms of transaction size, it's a big variety in terms of obviously notional traded volume distribution. It's 20/80 rule, right? There's people concentrating in the high end, but we love to support from smaller nodes point of view. For me, it doesn't matter, right? Liquidity is liquidity.
Okay. All right. So let's start to wrap up. Crypto and AI, as I kind of mentioned in the beginning of the interview, they like to see themselves, at least from the crypto side, we like to see ourselves as cousins and see us rise together. But I know you don't follow crypto as much as I do, but there has been a bit of a divergence as AI keeps going up and up and up. Crypto has been struggling, and I would love to just kind of get your sense of how you're seeing like broader macro trends. Like we're still in, I guess, like an environment of euphoria in light of the SpaceX IPO. We're going to have Anthropic and OpenAI go sooner. I think SpaceX just issued more debt right after the largest IPO in history. I mean, if that's a sign of frothiness, if that's not a sign of frothiness, I don't know what else is. But like, how are you seeing demand for GPUs and AI in the next like 6, 12, 18 months? And to the extent you feel comfortable talking about how it might relate to crypto, I'd love to get your thoughts.
So our world, so I think the world, not just US, is bifurcated in a way where you see tons of productivity gain, investment dollar-wise, company valuation, to just in general spend and everything, right? In the AI semi industries, crypto, that particular segment, a lot of capital goes in. You see tons of productivity gain. You see stock prices overall across all goes up, right? Import export, right? People exporting semis and the Koreans, and they've been experiencing tons of growth. And then other segment of industry, right, different bifurcated, right, is not doing as well. A lot of traditional businesses, right, even in America, or even in China, even in Korea, right, they're just static for the most part, right? Traditional marketplaces, traditional industries, to a point where they will start enjoying that kind of growth because of AI, ideally, right? Or other things that'll be interesting to see. So now crypto again is one of the what they call the industry verticals in this world, right? So obviously, I think right now they try to link, say, hey, AI is going bonkers. Let me just tag along, right? From AI infrastructure point of view, some of them are doing so, right? Maybe they can tag along, or they try to figure out a way to grow themselves in different ways. Obviously, payment is a big deal. Obviously, tokenize other asset classes within the financial industry is a big deal. So all those things can be helpful. But in general, I think the world is pretty bifurcated, right? The traditional industries versus AI semi world of what we're doing here. And then next 12 months, I'm not smart enough to tell next 12 months, but what I can see from my forward curve, right, still huge demand for AI. And then we see a proliferation of obviously LM token, LM models in general, right? Open source, open weights, closed source, they keeping, which is good. We want the competitiveness of the industry. And token prices obviously partially driven by the GPU prices, partially driven by the competitive nature of the industry itself, and go up and down. And the mixture of the models go they change all the time. So things pretty interesting. Yeah, lately.
Yeah. What do you think is the biggest risk to your business over the next 12 to 18 months?
Yeah, so I think where we stand from both company point of view, we're in an interesting stage where both company agnostic, right? Silicon Data, we benchmark all different GPUs, not just the 1-2 design houses, right? We are completely agnostic in terms of indices calculation. We do have a AMD indices, MI300, right? So computing side, again, we're completely agnostic of chips, right? We have done a lot of AMD deals, right? We have to do any design house, any independent design houses. We work with all new cloud providers, all different clients, right? So in a way, we are hatched against individual trends, right? TPU or particular chips doing well, particular design house doing well. We hatched in that sense. So the only thing can happen, knock on wood, is just no one use compute, no one use AI, no one care about the market, right? So then if no one use compute or AI, no one need to hatch, right? Obviously, and then no one need to do transactions in small markets. So unless that happened, those two companies are well positioned to grow with the industry.
Gotcha. Okay. And just again, because we are primarily a crypto show, I just want to, before I give you a chance to share any other final thoughts, look into your crystal ball and maybe a year from now, how big a part of your business do you think crypto or like blockchain based financial rails will be? As how big of a part of your business do you think it might be?
So from the payment point of view, right, from compute change, we can support, we're ready to support any payment types. So if there's a need from both sides, happy to do that right away, right? We're very unbiased in that sense. So it depends on the market adoption again, right? From Silicon Data point of view, obviously issuing perps on some of the products in different venues is something we're actively engaged in discussion. For me, it's just find the right partner, find the right venue, right product construct, right, and the right timing. That's a critical thing. So yeah, maybe the liquidity can come, and obviously, I kind of think once the traditional CME future launched, we will see a lot more institutional participants centered around our indices, and then those folks may be more willing or happy to trading other products, similar products, in perpetuity forms, right? So I think the industry will take up pretty nicely next year.
Okay, great. Well, we're at time, but before I let you go, any other final thoughts that you'd like to share? Any contributions you're trying to get off your chest?
I keep telling people I'm not cool. I wasn't, I'm very close to crypto all the time, but never cool enough to be in the industry, right? So as a full-time market participant, so I love financial innovation. I think it's something I'm really, really excited about. For me, I'll find the best product and then bring the institution player with me, right? That's who are supporting us so far in traditional markets. I think people are exploring with us together. So yeah, excited to learn more and then do more.
All right, great. Well, I've never been called cool in my life either. I think we have kids around the same ages. And one time, I don't know if your kids use the term goated, but I think my oldest daughter used the term goated to describe when I opened a jar of jelly. So I guess I'll take that. But Carmen, great to have you on. We'll have to monitor your progress and see what happens. And yeah, thanks for joining us. And yeah, and so that wraps up our show for this episode of Bits and Bips, the interview. Thank you to everybody for watching and joining. And tune back next week for another exciting episode. Have a good day.